Ladies and gentlemen, welcome. This is Christopher Aaron. It is April 10th, 2019. I want to look at this topic of gold versus the stock market, especially U.S. stocks. And this topic, is there a stock market crash ahead? Because we see headlines about this quite often. And the gold market, of course, tends to offer protection during certain times from falling stocks. So we want to look at this relationship and see what is actually setting up here from a technical basis for the potential of a stock market crash. So as a backdrop, if you've been watching this channel for a while, I want to remind you the philosophy that we use here, which is a technical based philosophy. So we can look at these fundamental data points for the stock market. And for example, let's look at this is called the Buffett indicator, named after Warren Buffett. And we're looking at the total value of all the corporate equities in the United States versus the total product of the entire United States. So it makes sense there should be some relationship to this, and when it gets out of whack, in other words, when the value of all the equities goes up way too high versus the actual product of the country, that should represent a bubble type of mentality. That should represent overvaluation. And sure enough, we see that. This was the NASDAQ bubble in 2000, the highest reading. So the point that I'm trying to make is that at this moment, we are just coming off the second highest reading ever in the U.S. stock market as far as valuations go. Okay, so this is a fundamental data point that could tell us that stocks are overvalued. And then we would think perhaps gold could be a counter-cyclical asset class if stocks are overvalued. Let's look at another data point. We're looking at the dividend yield in the S&P 500 dating back to 1870. You don't get to see too many charts that offer 150 years worth of data. Dividend yield is how much you are being paid to own stocks. After all, the point of owning stocks, which are businesses, is to get paid. You want to be paid to be an owner of a business. And so this is the amount that you're getting paid. And what we can see here at 1.9%, this level is less than even the amount you were getting paid before the crash of 1929 in the stock market. Okay, similar to the crash of 1987. Now, so once again, we're looking at basically the second cheapest reading outside from the NASDAQ bubble in the year 2000. One thing I want to draw to your attention, though, is if you look and you see, we have basically been historically undervalued as far as dividend yields for the last 130 years. This has been going on for the last 25 years here in an anomaly of sorts, okay, this 25-year period that we've been living in. So stock market is overvalued by that metric. Let's look at one more. We're looking at the amount of debt, the margin debt that investors are borrowing in the red here versus the price gains in the S&P 500 itself. So we can see basically just coming off, 1 year ago, but this level exceeded the top from 2008, the worldwide financial crisis, exceeded the top in the year 2000. So all things considered, we would have to say that we are pretty fundamentally overvalued here for U.S. stocks, right? Now, here's where the difference comes in between my form of analysis and what you will see elsewhere. So I can agree with you that the stock market is fundamentally overvalued, but let's really be honest about this and remember that overvaluation periods are largely driven by psychology. And these periods of time can become bubbles, they can become manias. Why? Because the psychology of the market simply doesn't care about fundamentals, and this can go on for years and years and years. So what I like to do is say, okay, we can understand this as a backdrop, but what is the actual market telling us at this point in time? So we look at this. This is the S&P 500 in the U.S. from the bottom in the crash of 2009. And just look at how clear the advance in the stock market has been Notice this magenta color, these long-term trend lines here, the solid one being more important, the upper one being less important, because you have to see a break of the lower trend line in order to start a new bear market. And we've seen 1, 2, 3 really nice hits, a couple false breakdowns. But just look at the clarity. You could not ask for a more clear technical trend for the market to be in. And so we were just looking at these indicators that are telling us that stocks are overvalued. Yet, when we look at the actual behavior of the market itself, it's not giving us any signs that there is a bear market approaching. No signs whatsoever. Now, we had the potential for that here at this recent low. And the point that I've made multiple times is that by definition, if you think about this, by definition, in order for a rising trend to become a falling trend, what do you have to see? You have to see the lows. You have to see a new lower low. And that starts a new declining trend. In other words, you have to see a break of the lower trend line. And we simply haven't seen that yet. So we were looking at this upper trend line. Now, notice it's in the dashed color here. The upper trend line less significant because we were looking at the beginning of a parabolic breakout. So the stocks started to follow this more aggressive trend line higher. They broke out of this, the top range of the market here, failed, but notice where the support came in, right here at 2350. So there, I mean, if you can't see that the market is following this trend right here, then this is a form of analysis that will not be ideal for you, because we can see here that the market is following a very clear linear rising trend despite being overvalued. So what does this mean? It simply means that people have been conditioned to buy stocks. They've been conditioned to move into the stock market. Year after year after year of gains has conditioned everyone. And right now what's happening, we are approaching this upper resistance band once again. And so if we do not see stocks rolling over here and begin to decline again, which it looks like they are not going to, it looks like there's going to be more of a range trade still with an upward bias, we have to keep the assessment here that stocks could go from overvalued, which they are now, to extremely overvalued. And perhaps even if they continue and make another attempt, follow my mouse here, another attempt at something of a parabolic move where they start to move almost vertically higher. Perhaps they go from extremely overvalued to absurdly overvalued. And so if you are at this point, if you're looking to short stocks, you have to be very careful. I just want to bring up the famous quote from John Maynard Keynes. Markets can stay irrational longer than you can stay solvent. So keep this in mind. It's not good enough to just look at the fundamentals, because markets, trust me, this could go on for another several years. So you have to be very careful if you're trying to short. And then I want to bring this back into, by the way, this is the line in the sand, this red arrow here. So once again, I said this in the beginning, we have to see this lower trend line broken. Right now it comes in at 2400. I've studied examples like this throughout history, and the definition of a new bear market begins when you see a market shift from a rising metric here to a falling metric. We haven't seen that yet. 2400 is the number we need to see broken below at this time. This number will be changing, by the way, as we go forward. Every month or so, this number gets slightly higher. Now, if you are investing in gold and precious metals because you are thinking that stocks are overvalued and therefore you want to protect yourself, this is part of the equation here. This is part of what we need to talk about. So let's take a look at this. We were just looking at the stock market. Let's look at the ratio of gold. We're looking at the ratio, of stocks versus gold. So now stocks are on the numerator and gold is the denominator of this. And the point that I want to draw to your attention here is that look at this data point down here in 2011, this represented the top in gold. September 2011 at $1,923 per troy ounce in the futures market. This was the top of the gold market in 2011. And we know the bear market that we've been in for gold. We know the bull market we've been in since stocks. And the question is this about to end? Are we about to see the new bull market in gold and the bear market in stocks? Now, we can see a very clear rising linear trend here in blue, very clear. And notice the most recent test just here a few weeks ago, end of last year, end of 2018, successful test. Look at the bounce of that. So you can see 1, 2, 3, almost a fourth hit right here, 5 hits. Now, this pattern, you can see this pattern. We have a rising trend in favor of stocks, and we have strong resistance in favor of gold going all the way back to 2002. There is a name to this pattern, and we can see this. We can visualize it here in green. You can see this. It's a triangle. Can you see that? So the lows are coming up, and there is a flat resistance that goes all the way back. We expect this to be coming back into this resistance zone at 2.45 on the ratio. Just remember, when this is moving higher, it means that stocks are outperforming gold. So this pattern, okay, this ascending triangle pattern, I've studied these throughout history. Basically, this is what I do in my free time. I study patterns, not just in stocks, not just in gold, across all the markets. And this ascending pattern, these patterns, although you can see this must end here by 2022, I will tell you from my experience, there are no ascending patterns that reach the very end of the apex here. Most of these resolve about 2/3 to 3/4 of the way through. So we are looking at most likely a late 2020 resolution of this. We're talking the next 12 to 18 months. Now, if you're investing in gold, or if you are thinking about shorting the stock market to profit from a decline, this is a very important ratio to pay attention to. Here are the ramifications. Now, this pattern results in a strong move. If this pattern breaks lower, the rising trend line, we just saw that hit there. If this pattern breaks lower, and by the way, right now the number we need to see broken is 1.85 here on the ratio. It closed at 2.21 today, okay? So about 0.4 points. And I mean, look at this. I mean, that can happen. This ratio can move 0.4 points within several weeks. We've seen that happen before. So 1.85 on the lower side is going to mean there's going to be a new bull market in gold. And if you've only been participating in the precious metals market since 2011, you have no idea how exciting this can be. To have gold being the premier asset class in the world, essentially, and stocks falling and people moving into gold, not just for one of these, multi-month moves that we've seen over the past several years, but for a sustained multi-year, perhaps multi-decade bull market. We need to see this 1.85 level broken. Once again, 2.21 at this moment. But for risk comparison purposes, if we see this upper level, once again, we're talking about 2.45, closed at 2.21, so it's only 0.2 points, 0.25 points away. If we see this strong resistance level broken at 2.45, this means stocks are going to enter, as John Maynard Keynes warned about, this irrational phase. And I have to tell you, if you look at a previous bubble valuation here, and we looked about the fundamentals, but look at the technicals, this could go on for years further. We could be talking, 2023, 2024, 2025 by the time the stock market tops. And can we imagine gold underperforms that entire time? The point that I'm trying to make here is that we will have an answer to this. There are times when you're studying technicals where you have to say we're in a range. Right now we're in this ascending triangle, and that pattern has to hold until it breaks otherwise. So there are times you have to say when we're in that period of indecision, and then when we get a break, there are times where you either go all in on gold or you go, unfortunately, you participate in the bubble, perhaps for short-term trading in stocks until that thing runs out of steam. So this is where we are right now. Now, from a technical basis, the thing that I just want to let you know, one of the rules in technical analysis, one of the guidelines, is that the bias of this kind of pattern, okay, the bias of this ascending triangle is in the direction of the prior trend, which in that case is up. So the bias of this, I've labeled this in red to show you, the bias of what the market is telling me is that within the next 12, perhaps 18 months, this is going to break upward, clear the strong resistance zone, and we are going to enter a multi-year mania in US stocks, and gold is going to underperform. This has to be the bias. So if you're watching some of these videos, there's a lot of smart individuals out there who know a ton about the fundamentals. And I just want to let you know, a lot of this, my history in these markets is that I was listening to a lot of the fundamentals going into the crash of 2008. And what happened? Silver ended up falling more than the stock market in the crash of 2008. Things like that. The gold stocks fell more than the stock market itself in the crash of 2008. And there were a lot of well-meaning individuals who just told us that could not happen because gold was going to serve as the safe haven. And so if you're watching some of these other videos where guys are talking about a crash setting up in US stocks or gold going to fill in the blank, $5,000 an ounce, $10,000 an ounce, why don't you show them this chart? Pause this video right here, show them this chart, point out the ascending triangle here shown in green, and get their opinion of it. Say, look, hey, you're calling for gold to go to $5,000 an ounce and the stock market to crash, but what about this? What about the fact that we are still in an ascending triangle formation in a valid rising trend for US stocks? What is their opinion on that? If they're just going to spout pie in the sky figures, well, I'm not interested. So what we do here is we attempt to align with the technicals. We attempt to align with actually what is happening in the market, whether or not it's rational. Because we still have to live in this world which includes rational, irrational, manipulation, no manipulation, fundamentals, no fundamentals. It's not either or. It's all of the above. It's all of this together. And the only place we can actually see everything happening at the same time is in the price. So that's what we do here. I want to let you know the services that we offer. Precious Metals Intelligence is for precious metals investors. It is geared toward the gold, silver, and gold mining investor. We have videos like this. This is basically a portion of the premium video that went out 1 week ago that I'm sharing with you here. We cover a lot more in depth, the US dollar, bonds, the GDX, all from the standpoint of precious metals investors. There's a new service coming out in the near future, which I encourage you to click on the link below if you would like to receive a free notice for when this is launched. It's not available quite yet. But what we're going to be doing is actually trading, for example, the stock market. We're going to be trading the bond market. We're going to be trading copper and platinum and all these things. Just the trades that we're doing here and the analysis that goes into that. Free notification when that's available. I also work with individuals. If you see this kind of analysis and you say, I've got $50,000, I've got $5 million invested in this sector, but boy, I'm just not sure what the pros and cons are of various forms of investment. I just want to let you know I don't take any fees or anything from any of the companies, any of the vehicles that I profile here. I simply look out for the best interest of individuals, of which you are one. Make sure to hit subscribe on this button on the YouTube channel. Thank you for watching. I want to thank all the supporters on Patreon for supporting these free videos. It very much means a whole lot to me. So we're looking, in summary this week, we're looking at the stock market. Remember that chart. It's approaching extremely strong overhead resistance. It's approaching those all-time highs in the stocks, but we also see no evidence that it's turning downward. It looks like it's gearing up for another shot at one of these parabolic blow-offs. So then when we look at stocks versus gold, that gives me reason for caution still on the precious metals. It makes me wonder if the stock market has to exhaust itself first before gold has its chance to really shine. Thank you.